Hey, a lot going on this week. Let's take a look here. Number one, rates continue to improve. Maybe not the actual rate itself, but the cost to get a particular rate. The fee to get a certain rate seems to be improving still. Uh, this may be due, number two, to a flight to safety where investors sell their stocks like they did today and they purchase bonds and mortgage backed securities. Warren Buffett's holding, I think, close to $350 billion as he liquidated stock holdings and is hoarding cash and bonds right now, kind of beating the rest of the investors to the punch as usual. What's happening? Number three, last week on Friday, a jobs report came in worse than expected. Fewer jobs out there, unemployment creeping up. Uh, Point four tomorrow, Wednesday, consumer price index comes out. We'll see how that looks. It should be favorable, meaning lower, meaning indicating inflation's coming down. Next Fed meeting is March 18th and 19th. There's about a 0% chance they reduce the Fed funds rate. Powell spoke last week and said they want to see how the new administration's policies start to take effect and affect the market before they make any moves at all. So that's kind of expected, right? Big point number six. Are we in a recession? Have we been in a recession? Should we have been in a recession, but all the government hiring prevented it? Uh, Maybe. A recession technically is 2 quarters of GDP, gross domestic product, getting smaller instead of growing. And we could very well be in or headed to a recession right now. They always know about this stuff years after they happen. They're like, okay, that's when the numbers hit. That's when we're in a recession. So take a look at this real quick after the rates, right? The rates are about the same as they were last week, 6.6 ish on the 30-year fixed conventional. FHA, VA, USDA, very low sixes, very easy to get into the fives on these. And bear in mind on the VA, that VA loan goes up to $1.5 million with no down payment and no mortgage insurance and a screaming good rate. So if you have the opportunity to talk about that, I can work that up for you, no problem. Let's look at mortgage rates and recessions. Okay. Uh, these are all the recessions since 1980. The thicker the green line, the longer the recession lasted. Okay. Now, 1980, this is the mortgage rate here, the guiding mortgage rate, right? The one I talk about, the conforming 20% down, good credit. Went from a 16% to about 11.75 in 1980 and 82. Didn't quite have a handle on inflation. It came back around, and Paul Volcker really smashed inflation by raising the Fed funds rate up to like 20 something. In 82, the mortgage rate went from 18% down to 13%. Yay, that's awesome, right? Good job. Nice work, bud. 1992, about 11% down to 8.75. 2002 here, post 9/11, 7.375 to 6.75. Post crash, post meltdown, about 6 to about 4.875, kind of meander around there. And then the 2020 COVID uh, recession, very short recession, but mortgage rates went from about 3.75 to about 2.75. So what's going to happen? I think rates are going to improve slowly, but it's going to be a rocky ride. You got to be with somebody that watches this stuff like crazy, like I do, right? Let's talk about something important. Fannie Mae Family Opportunity Loan. I'm doing one of these right now. This is what we used to call a buy for, when parents used to just buy a house for their kids or for kids getting ready to just buy it for them. In that circumstance, it's like buying an investment property. It's not like buying a second home. They got to put a big down payment down, and there are higher rates associated with that. This is not for that. This is for that first point there, aging parents who cannot work or cannot afford to purchase or can't qualify, or a relative, maybe a son or daughter who is on disability and can't work and cannot support a mortgage payment or qualify debt to income wise. Maybe they can't even sign. Like my dad had that problem for a while where he didn't know who he was some days, so he couldn't get him on to sign documents, right? So what this provides, point two, is as if you're buying a primary residence, but you're buying it for mom or dad or one of your kids who cannot qualify. So primary residence, interest rates, and guidelines. Point three, it ignores the distance between your home and the home you're buying. So typically an underwriter would say that's too close to the one you're buying. That's either going to be an investment property. It can't even be a second home. It's got to be at the beach to be a second home or something like that. This is primary residence guidelines for a home that you're not going to live in, that you're buying for mom or dad or a kid. So as little as a 5% down payment. Cool thing, it can be up to a fourplex. You can collect rent from the other units. So you can put mom or dad in one unit and then collect rent and be a landlord and kind of support the payment that you're trying to make for them. The example here that I'm looking at, though, this is what I'm kind of predicting a little bit. I wish we could have done this. Say you don't want to put mom or dad into a facility, right? So maybe you buy a duplex, maybe do a little renovation in there, and maybe one side is mom, dad, or the kid. The other side you rent in a very friendly manner to a personal caregiver who can, have their family. Maybe they're in a good school district or something, but they're kind of on call to pop over and help out and help you out because it's a full time job, right? So this is a really cool loan. I'm doing one in Salem right now. You don't have to refinance when the property is vacated by the relative. You can keep it for as long as you want to. You do need to kind of prove out with a doctor's note or something like that. They're infirmed or don't make enough money or don't qualify, and that's not a mountain of paperwork. Just the stuff you might think would be normal there. So think about this as you talk to people. We're all headed that way, right? And so it's a good opportunity to keep your parents or loved ones kind of closer with a little more dignity than just going into a facility there. So that's what I have for you this week. Thank you so much. Have a good day.